The gold price has been bothering me for the last couple of weeks. I want to talk about this today. I also want to talk about Tesla earnings and why the stock is reacted negatively after a very good earnings report. This is the Not Even Wrong podcast. It's July 23rd, 2020. This is Krim Delco. For the day, the fund is down 9.5% as we speak. The market is still open. The market is down about 1%. So the fund is clearly underperforming. And let me talk about this a little bit. So we have Tesla's earnings yesterday. After hours, the market prices up the Tesla stock to about 6% plus. And then it starts sliding even during the call. And this morning again opens up 6% plus and is now down about 4.5%. And why is that happening? Well, the earnings call was more or less what we expected. I would say slightly positive on the ZEV credits line, which was the main driver of earnings. I think there's one concern that is prevalent in the market, which is the ZEV earnings are not translating into cash flow immediately. And there's a bit of a, I think, concern or even thought in the market that maybe this money will be hard to collect because it comes from companies like Fiat Chrysler, other European car makers, maybe some US car makers, but who knows how they are doing these days? Who knows if they file for bankruptcy, where Tesla would stand on the credit line? So those are concerns that I think are valid. So this profit has to be taken with a grain of salt. The inclusion in the S&P has to be taken with a grain of salt because it's not coming from the actual core car business. It's coming from things like ZEV credits. And while that's real money, it hasn't translated into cash yet. So we have to be very careful about that.
List is the comments that Elon Musk made about, he said, I want to be a little bit profitable and maximize for growth. I think some people took that the wrong way. It means that he's going to give up a lot of the margin improvements back to customers and drive growth. I think they made it clear that they want to lower cost, lower cost, lower cost, but it wasn't so clear that that lowering cost means necessarily profit. Now, I don't think that that's a massive concern that we should have because, you know, this is the game that Amazon has been playing. This is the game that a lot of disruptive companies play, which is drive down the cost curve, increase volume, become dominant in the market. So I think overall it's a concern that we have to pay attention to. We can't just grow and maximize for growth all the time without making money. But I don't think this is an issue. So I'm just mentioning this because I paid attention to it during the call, and this is a podcast which should be transparent about our thinking. So this is part of our thinking, but we are not concerned about that. I think lastly, a couple of executives came out on the call talking about the need to hire people. I think it just makes it clear that all this growth, all this potential in Tesla, in the end comes down to people solving problems. And they need the best people they can find to solve all those interesting problems that are available to be solved. And I just want to just putting it out there that this is not, it's not that straightforward. And I think if you combine all this with the rally in the stock price, just to remind people that for the week, the stock is still up slightly. Like our fund for the week, we're still up about 1%. So we had huge swings. Monday, we were up 18%. Then we were down 11, then up 4, and now we're down 9. So you have these swings in the market. For the year, we're outperforming by 131%, the S&P. So we have a massive outperformance, and that sometimes these reversals happen in the market, and that's fine. We have to live with that. I think one of the things that we always mention at Orange Capital Partners is that volatility is not something we manage. Volatility is part of the game, and we have to learn to deal with it. This is part of our value added. Now, to get to the second point of this episode, it has nothing to do directly with Tesla, but indirectly, and it's the gold price. The gold price has been rising in the last couple of weeks, and gold is now, I think, close to all-time highs, and that's not a good thing. I think gold is the antithesis of progress and economic growth. So when the market is pricing up gold, it warrants caution because the market is telling us that all this money which is being put in the economy is is not really producing what we're expecting, which is economic growth, wealth creation. It's just a redistribution of wealth. And gold, unfortunately, I don't have a problem with gold, but I have a problem with people that buy gold because buying gold is really just rich people protecting their wealth. It doesn't help anybody. It doesn't help anything. Nothing is created. It's a contract between rich people that they can park their money in this asset and that they will always be ready to buy it back from each other at a certain price, which is hopefully higher, hopefully from their perspective, higher than today's. My thesis was that in a deflationary environment with disruption, we could have a depreciation of gold. This is the good scenario where we have a lot of liquidity in the market, investments in ESG type social, environmental governance type companies that are adding to the welfare of the whole society through their disruptive technologies. They're not just dominating markets and monopolizing products and services and generating wealth for a few employees and maybe a few not even shareholders most of the time. It's just some insiders. No, these companies, these disruptive companies, they generate wealth for themselves and a massive amount of welfare for the rest of society. My hope was that this will prevail and that we will see a disruptive, deflationary growth cycle starting in the US. And unfortunately, that doesn't seem to be priced right now because gold cannot gain in value under this scenario. The scenario under which gold gains value is, first and foremost, it's an inflationary scenario. So that means that the gold price is pricing inflation, even though we don't see it. There might be an underlying inflation in the market driven by the massive amounts of money creation by the Fed. And a lot of monetary economists will say, well, duh, of course that's going to happen. I am not 100% sure because the velocity of money is not very high. This money is not going straight into the economy. This money is being held to fill holes and prevent people from bankruptcy, but it's still going to create uh, deflationary dynamics because for example, take a piece of real estate in New York City. Let's say it's priced at $15 million. That piece of real estate maybe should be worth $5 million to get a real buyer. So there's $10 million of delta. The Fed, with its actions, is preventing that piece of real estate to fall down to a price where there's a real bidder because it's keeping the current owners and the current creditors alive by just printing money and giving them the ability to roll their debt and et cetera, et cetera. My point is that even though these people are not going bankrupt, even though this money is not circulating, in the end, the price of that piece of real estate will slightly fall year for year until it finds some sort of equilibrium, which might not be 5 million, maybe 10 million, but it's still, there's going to be deflation. And I think this example should illustrate how I feel about the whole economy. On top of that, we have the disruptive force in the economy, and that's where companies like Tesla come in, where through R&D and technology and research and science, they're able to lower the cost of production and deliver more value for less money. If you add that to the deflationary effect of monetary policy, you could have a deflationary scenario with some economic growth. You could have that scenario, and under that scenario, it is highly likely that gold will actually be worth less in the next 5 to 10 years. The other scenario where you have inflationary kind of monetary policy, which is what most people think is happening right now in the market, that would be a scenario where the rich just do nothing. They park their money in gold. Money is being parked in many places where it's not circulating. The income gap is widening because there is no real economic growth and real disruption. And we have inflation and the poor are getting poorer and the rich are getting richer. That is a very, very bad outcome. And unfortunately, that's what's pricing in right now in the gold price. And For myself, I would suggest that one way to circumvent that is if the Fed actively shorted gold just to increase the confidence in the market, because we don't want to have a rising gold price. It's a bad thing. I know a lot of people in the market are happy to be long gold. They think that's a good idea and all that. It's fine for them. I don't want to debate them. I just feel for the confidence of the market and the entrepreneurs in the economy, a rising gold price is not a good thing. A declining gold price would be a much better thing for confidence. So this is just a suggestion coming from me that maybe as part of active monetary policy, actually making sure that the gold price doesn't go up will be a good tool for the Fed. This is just an idea again. So to summarize, we have a reversal day today where growth, disruption, and economic value is being sold in the market, and things like gold and other useless things are being bid up. So it's a reversal from my hopeful scenario to the more not so hopeful scenario. These things happen, the reversals happen. For the week, we're still up. And of course, we're still very confident that at least with our investments, we will see the disruptive growth and real economic value being created. Thank you.